the two most important days of your life. The first one is the day you're born, and the second is the day you work out why. When I realized that we could make good money and we could help increase the development of affordable housing, put people into homes with the skills that I had, that was a big moment for me. What I wanted to do was create like a Trojan horse. Could I build something that fitted within the investment parameters of a institutional asset owner that would allow them to see that you can do good, make good money at the same time? I think most people who are trying to raise impact funds are avoiding the use of the word impact. You find that people are dancing around returns first, impact first, depending on the audience that they're trying to raise money from. My dream and my hope is that we can acknowledge the fact that there are costs and complexities and trade-offs that do come with impact, and that's okay. And then think about the different sources of capital that we have around the world and find ways to bring them together at scale.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Richard, thanks for coming on today. And I have been really looking forward to getting together for a while now. I want to start with something that I think has shaped everything about who you are. I know you grew up mostly in Australia, but your story actually begins earlier because you moved there when you were 4 years old. And that's because your parents were forged in the shadow of World War II. Tell me about your parents and their journey to build a life in the new world shaped the person that you became.
My mother left Berlin in 1937. She was Jewish. She went to South Africa. My father grew up in war-torn Austria. He left and went to South Africa just after the war looking for work. They met there. He was a hairdresser, actually. They started with very little. They moved back to Austria a number of times, but ultimately came to Australia. Most of my mother's broader family were killed during the war. My grandfather on my father's side served in the Austrian army, which became the Wehrmacht, and was a prisoner of war in Russia. And I think it certainly gave them a broader perspective on things. My mother was a remarkable woman. She spoke 7 or 8 languages. She was going to be a doctor, actually, as a woman in the 1940s, which would have been extraordinary. But all of the places in the medical schools were going back to soldiers returning from the war. A very sort of bright woman that had lived all over the world and understood what it means to be marginalized. It always surprised me that they stayed in South Africa for as long as they did, although they kept trying to leave, but finally left in the 70s.
How did they settle in on Australia?
They'd spent a number of years in Africa, and Europe obviously recovered from the war, but still has a very different mindset of what I'm calling the New World, or what we call the New World. Guilds, difficult to run businesses, bureaucratic, and I just think that the opportunities were better. And certainly once they found Australia, which is truly an extraordinary place to live, the weather's good, there's opportunities for everyone, and I think it is a very egalitarian place.
Your father was a businessman?
He was a hairdresser. He had very little education. I went to South Africa, started working as that, and he built up a business of hairdressing salons. So at one point, I think he had 16 or 17 or things like that. His English was poor, but he was a very canny businessman.
You described yourself to me as officially the most lucky, blessed human in the world. And you say that this extraordinary good luck gave you the capacity and actually the obligation to serve others. I want to understand the weight of that. When did you first understand that your parents' survival wasn't just about you being fortunate, but about you having a certain responsibility?
I've been incredibly fortunate. They obviously came through a bunch of trials. I had a wonderful home that I was brought up in, I had a good education. I went to a Jesuit school here in Sydney. It was a boys' school, very strong in the idea of being what they called men for others. It's hard to put a finger on why I always felt that way. I think it was probably mainly my mother's influence. But as we wrestle with why we're here, purpose, and for many people, there's a religious answer to that question, which gives you certain direction. There's 8 billion people on the planet. Such a small proportion of that have the fortune that I do. It's hard to wrap your head around what that means and what that means for you as a person. The way it always made sense to me was that I have an opportunity to move the ball forward a little bit, which is all I can really do. But if I'm not using what I've been given to make a positive difference, then I struggle to think about why else I would be here.
That's interesting. The seed that's obviously grown within you. And then sometime in the 80s, you went off to study at the University of New South Wales, where you earned a Bachelor of Economics. Why economics? Why that school?
Well, I wanted to be an actor, to be honest, and make films. And I did a lot of theatre when I was young. And my father, very rational business person, said, you can't do that until you've got a degree in something sensible. Economics is what it was. I really hated it, actually. I really struggled with it. It's only now that I love economics, but back then I didn't enjoy it at all. My university career was a debacle. I failed more subjects than I passed. But I did run the beer society on campus, so I had a lot of other things going on. The reality was my degree took so long because I'd struggled, or I really wasn't that interested, to be honest. It took so long. When I finally got it, it was time to get a job. By that point, my theatre days were long gone. But it was just about doing something sensible and getting a degree. He always believed you either needed a trade or a degree, and I got that degree in the end.
You pursued economics, but did you also do theatre in school or what?
I did sort of amateur theatre, and I was very big fan of film and played around with some short films and those sorts of things. But once I left university, got my first job, and my father died while I was at university. I was 20 when he died. That kind of meant I had to grow up a bit more quickly. Together with my mother, who lived for another 20 years, I was running the businesses. And so by that stage, my theatrical dreams were very much dead in the water, at least for a while.
You ran your father's businesses once he passed?
We looked after them. We ended up selling them a number of years later. It did mean that I did grow up more quickly, I think, than I would otherwise have done.
Took the stars out of the eyes a bit. But at some point during your studies, you started trading shares.
Been trading shares at school. So I'd always had an interest in financial markets. We used to go to a public phone booth and dial the stock exchange to hear the prices of shares. And there were 2 different numbers, one for A to K and one L to Z. So now I'd always had an interest in investment markets. And business generally. I was trading shares, not particularly successfully, which I think is always an important thing. My children, they've been in and out of shares. They're only very young, but when they get money from their grandparents, half of it goes into shares. Because we're in the middle of a bull market, they haven't learnt the same lessons yet that I learnt quite early.
You actually were trading during the 1987 U.S. stock market crash. That's not common to be trading shares when you're in high school, and certainly not with your friends. Was that common at your school?
Not particularly. I mean, they do a lot more these days. They encourage stock market competitions and things like that. But certainly back then, it wasn't an easy thing to do either. You'd have to go into a broker's office in your school uniform. It was not an easy thing to do.
Was this high school or was this university when you were trading through the 1987?
That was high school.
High school. And most people at that age have no concept of what a market crash means. You were in it. Were you experiencing fear or getting to know about volatility or chaos at that point? Tell me about that day. What do you remember?
I don't remember the day itself, but it was a very exciting time. There was a lot going on. I didn't have a lot of money in the market. It was exciting. The first thing that came to was, is this a buying opportunity? In the end, of course, probably was in the long term, but certainly it was a pretty dramatic day. And it was only many years later that I understood a lot of the nuances of that day and the programmatic trading and the various other things that impacted it.
After you got out of university, which sounds like you were on the extended plan, you did start your career.
I started my career just in data entry for a small company called Assirt, which doesn't exist anymore. And it was a research company that built databases on the funds management industry, but also rated fund managers, gave them a score. It was pure chance that I ended up there. And as I said, it was just a data entry job, first job out of university, but fantastic opportunity, because what it meant was it was the absolute building blocks of the investment management industry. I worked there for about 5 years. So I started in data entry. Then I went to rate or assess fund managers. And then I moved to the internal funds management business, which was advanced asset management, which managed not that much, a few $1 billion, had some good relationships with offshore managers like Morgan Stanley and Mabel Brown Abbott in Australia. I learned a lot about the industry in those years.
So you spent about 5 years at advanced asset management. What year does that bring us to?
We're now in the late 90s.
You landed at Perpetual Investments somewhere around 2000.
So I went to Perpetual Investments, one of the oldest financial services companies in Australia, dates back to the 1860s, I believe. And Perpetual Investments, particularly at the time, was really one of the most dominant fund managers in the country, most well regarded. And I spent 13 years there. I had a wonderful career there, did a number of things. I was involved in all aspects of investment management. So I was involved in distribution, building products. I managed money, managed the multi-asset funds. And then ultimately, I was an executive there running a big part of the investment management business end to end. So Perpetual was highly regarded in particular for its Australian equities. It did a number of other things. We had a very strong fixed income capability. We had a relationship for many years with Fidelity, where we offered Fidelity's global strategies into the Australian retail market. There was hardly part of Perpetual that I didn't touch.
And function-wise, did you sit all around the table?
Yep. So I started there sort of more on the distribution side, and then I moved into the investment team, worked with the chief investment officer for many years and helped him manage that team. And then ultimately was an executive in charge of most of the funds management. The interesting thing about Perpetual is it was originally a trust company. Wealthy English people would leave their estates or their assets with Perpetual when they went back to the UK in the 19th century. And ultimately, a lot of people ended up using it as a trust company for their wills and estates. So it's the ultimate trust. It has obligations that last into perpetuity. And so that sort of influenced the way they managed money. We started managing together with the CIO, and I built the first sustainable fund that we had at Perpetual in 2003, which was pretty early on in the Australian context. But we felt at the time that it was very reflective of who the organisation was and the way we ran money.
Had you been thinking about that? Because until now, I hadn't heard anything about impact or sustainability or SRI or anything. Was this something bubbling in the background for you?
No, to be honest, not for me. I was aware of these sorts of strategies and we'd seen them offshore. We felt that it would be good to build a capability there, really because it was aligned with the sort of the brand and the ethos of the organization. But up until this point, I hadn't yet had my moment, which I'm sure we'll get to, where I realized the power of capital and what can be done with it.
This was kind of your first foray, getting your feet wet and maybe planting a seed. I think at the same time when you were at Perpetual, you also served as president, or at least part of the time, of the CFA Society, Sydney.
I got my CFA charter in the early 2000s and I volunteered to support the local chapter, which was the Sydney Society of Financial Analysts at the time. I ended up being involved with them for many years, for 15 or so years. So I was on the board for a long time and I was the president for a while and did a lot with the CFA Institute globally, marked exams, which was a lot of fun. Was on the conference committee, was on the Future of Finance committee. For those listeners out there who are CFA charter holders, I always recommend becoming involved with the local societies and the CFA Institute more broadly. It was just a fantastic set of experiences. It gave me friends from all over the world, learned about boards and governance and business again.
You travel to Virginia every year for a week to mark the CFA level 3 exams.
Yeah. That was a lot of fun.
That's a hell of a sacrifice of your time. Why is that important?
That was a gift. These days, they're all marked by computers, I think. But back then, the way the CFA Institute marked the level 3 written test was to bring charter holders from all over the world to Charlottesville, Virginia for a number of weeks. Actually, I only ever did one. Some people would do several weeks. It was like summer camp. It was great fun. Be holed up in a Motel 6 or something. People from all around the world. You'd mark one question, by the way, for the entire week.
And then somewhere around 2013, you made what looks like maybe a lateral move on paper, but was probably much bigger than that. You left Perpetual to become the CIO of First State Super, which is now Aware Super. And that's managing at that time, I think, over 54 billion Aussie dollars for more than 750,000 members. What made you want to move from a listed asset manager to an asset owner?
We've got to go back just a step. Probably one of the most challenging and interesting parts of my career was the global financial crisis. So this was much less fun than the crash of 87 for me personally. So at the time, I was a group executive in charge of what was called income and multi-sector at Perpetual, which was all the fixed income, credit, commercial mortgage lending, various other capabilities within Perpetual Investments. And it really was the eye of the storm with respect to the credit crisis. That was a very challenging time. We had a number of strategies that put our balance sheet at risk, and we came very close. It was existential for the organization. And unfortunately too, we had a very old retail product, which these days you'd call it private credit. It was a commercial mortgage lending product, and it was locked up. Governments all around the world put guarantees on bank deposits. These vehicles were seen as shadow banks, and there was effectively a run on them, which meant we had to suspend redemptions for those funds in order to protect the returns to unit holders. One of which was my mother, for example. People like her, a lot of pensioners, a lot of older people would invest in this fund, and they would use the dividend check every month to literally buy their groceries. And tragically, it got locked up in that environment, and that was very difficult. And it effectively ended that business. We had to run it down over a number of years. That was important because what happened at the time was I had a big team there that were fantastic. The writing was on the wall. We were going to have to shut it all down. And I was desperately looking for other sources of capital that we could use to keep lending on small ticket commercial mortgages. We were approached by someone that had an idea. And at the time, there was a thing called the National Rental Affordability Scheme. It was a federal government incentive scheme to try and attract private sector capital to affordable housing. We developed a strategy built around this scheme that would look to raise capital from the market and then lend that capital for development on affordable housing, and then use the incentive structure from the scheme to enhance the return back to investors. And I'd never heard of anything like this before. And that was a big moment for me. I sometimes say the bumper sticker that goes, the two most important days of your life. The first one is the day you're born, and the second is the day you worked out why. When I realized that we could make good money, we could get good returns, and we could help increase the development of affordable housing, put people into homes with the skills that I had, that was a big moment for me. And what happened was we developed the strategy, we went out, we tried to raise a lot of money for it. And in the end, we weren't able to raise anything. And because we were pitching an idea to institutional investors and pension funds, this idea that you could get great returns and make a meaningful difference at the same time. It was, the word impact wasn't used. We didn't know that word. And it was just a bridge too far. And so when I was offered the role to become a chief investment officer of an asset owner, I jumped at it because I felt that would be one step closer to the capital. But I felt strongly that particularly not-for-profit asset owners or not-for-profit pension funds who have many hundreds of thousands, if not millions of members, the way they invest matters. But I felt that going there rather than selling to them would put me in a better position to explore this idea of actually using the very small skill set that I have to actually make a bigger difference.
When did you hatch this idea at Perpetual? Was this after the crisis? Was this like 2010?
It was about 2010. We'd worked through the really dark days. And now this very large mortgage fund was shut and it was in rundown. And we were looking for any opportunity we could to raise other capital to keep the team that I had still out in the market lending. So it was about 2010, I think. And it was a great man, actually, who we knew through someone who's big in the impact community here in Australia. Andrew Tyndale is his name. And it was his sort of work that led to the development of that approach.
And then you tried 3 years, but just couldn't get any traction on it. What did you call it? You said that there wasn't the word impact investing. What was the pitch?
The fund was called GRAIL, Affordable Investment something. The word impact certainly wasn't used here.
So then you landed at First State Super, and you described somewhere along the line about having a single focus on the member as being liberating. That's an interesting word choice. What was liberating about it? What constraints did it remove? Or what new types of decisions did it allow you to make?
There's two elements to that. The first is that all good investment firms know that looking after their investors is their primary concern, their fiduciaries, and their job is to maximize returns subject to risk. However, in a for-profit environment like where I'd worked, there's still a tension between shareholders and clients and investors. And you put the right constraints around and you manage through that. And I'm sure all high quality firms do a good job of that. But nevertheless, there is a tension, and at points it can be challenging. The Australian superannuation system, pension system, has a big proportion of not-for-profit funds that are effectively owned by the members. And First State Super, which has since become Aware Super, is one of the large ones. So there, your owner, your shareholder, is the same as your client, who's the member. And it really is a somewhat liberating feeling when you take that extra element of tension away out of decision making. And they used to have little statuettes of a generic member in every meeting room that would sit in the middle of the table. So whatever decision you were making, you were always mindful that you were just an agent of the member. That was a pleasure. But then the other thing was, I'd read a piece of research by Roger Irwin, who had written a piece not long before I'd started there about universal ownership, which was a new concept to me. It basically talked about the idea that the very large asset owners of the world effectively they're so diversified, they're so large, theoretically, they own a slice of the whole ecosystem. And so actually what's going to drive their long-term returns is in many respects not which stock or bond they buy, but actually the performance of the whole ecosystem. If they extract a rent from one part of their portfolio, they're probably going to pay for it in a different part of their portfolio. And that was a very important sort of framing when I arrived at First State, when I was thinking about my job as an allocator of a large pension fund. Just being mindful that you're endogenous within the system, or you're leaving a footprint in the sand when you walk, and the system is going to impact parts of your portfolio that you can't directly control. So the example that I think Roger used in that first paper was around insurance premiums going up if there's climate challenges. I think he used an oil spill as an example. You might not own that stock, but you might wear the impact of increased insurance premiums. The more diversified your portfolio is and the long time horizon that pension funds have, the more subject you are to the impacts of all of these externalities effectively coming into your return stream.
So this kind of hatched this concept that you started talking about a lot during this time called universal ownership. Or was that Roger's term?
I don't know even if he coined the term, but I used it from him.
The concept is that when you're managing such a large amount of funds and diversified, you can't escape systemic risks. That obviously affected you, but then what changed in terms of what you in your role once you understood that?
So it started theoretically. What does that mean? I suppose the first thing that it meant for me was that I became more mindful of the second and third impacts or implications of our investment decisions and the fact that we were part of the broader ecosystem. Very simply, we added that dimension to the assessment of every investment that we made. So every investment that we made, we would do all the normal fundamental research on it, but we would also explicitly consider universal ownership. What does this mean in terms of the externalities that it creates or it's subject to? So we embedded it in the process. But what I really wanted to do was I wanted to find opportunities to prove the point, if you like. I wanted to find opportunities where I could actively invest in a way that I could see a positive externality being created alongside the financial return. And I couldn't find many. I could find lots where we did a lot of development, obviously, which involved a lot of employment, a lot of productivity gains, a lot of improved transport or healthcare. But explicitly saying we're going to deploy this capital and we want to see this particular social or environmental outcome alongside that return in a way that worked within the constraints that I had, that was too challenging.
Give me a real example, a decision you made at First State Super that you wouldn't have made if you weren't thinking about universal ownership.
We did a lot of work into aged care. We did a lot of work into housing. We invested in healthcare. We invested in ways that supported the state government, who was one of our key stakeholders. But they were all done with the fiduciary hat on about returns. We were mindful of these things, but we never, of the externalities, but we never compromised the returns that we were looking for. I wanted to do much more investment into social housing in particular, and we just couldn't get the maths to add up. So we did a lot of work into it. We held forums with the government, with social housing providers. We did a submission to the federal government on mechanisms that we thought might enable us to invest more into social housing. But ultimately, we couldn't generate the sorts of returns that we needed to for our members and deliver that sort of shorter term, meaningful social impact.
So does that mean you started to make some investments like that, but then sacrificed return?
No, we didn't. And I never wanted to, because at this stage I was thinking to myself, why am I here? What can I do? I created a little mission for myself. Years ago when I looked, there was about $150 trillion in $150 trillion US in asset owners, pension funds, sovereign wealth funds, etc. around the world. Global GDP at the time was about 70 trillion. So you have this enormous weight of capital sitting in these asset owners around the world. And this is a phenomenon, by the way, of the last sort of 20 years, the sort of financialization of our world. And those are controlled by relatively few people. And when you think about asset consultants and the roles of other people in the system, relatively few people control that vast amount of money. And in the context of our world, if you think with a universal ownership mindset, there's no way that capital is not going to be deployed, and the implications of that deployment will shape the world that we retire into. Being mindful of these externalities and the volume of capital, I thought, wouldn't it be great if I could help unlock that capital to be invested in ways that is explicitly mindful of the impact that it creates? And if you think about that amount of money, that can only be unlocked to create positive outcomes if it generates the right levels of returns, not if it generates concessional returns. And so for that reason, ever since then, I've been kind of obsessed with the idea that there is a role for concessional returns, and we can talk about that. And arguably they need to come together, which is a very important point. But if we want that 150, is probably $200 trillion now, I don't know, to be deployed in ways that's mindful of our futures in a more explicit way, it's only going to happen if they're able to invest in things that generate the sorts of returns that they require. So no, I didn't compromise on returns, but I did look for ways to structure things so that we could get the right returns. And so the work we did with the federal government was about what mechanisms could the government put in place to facilitate institutional investment funding social housing, in the same way that NRAS scheme was effectively a federal subsidy that facilitated great market-based returns for investors. Are there other ways to be able to do that? And that was largely my focus.
You changed your mindset to more of a impact first, but then it had to have sustainable returns, whereas before the system was more geared towards returns first.
The whole impact first, returns first thing gets very cumbersome, unfortunately. And I don't think as a system, as an impact community, we've helped ourselves very well by getting caught on these. The way I would say it is this: fiduciary investors have a job to do, which is to generate the best risk-adjusted returns they can for the given level of risk that they have to take on. And that's just not a negotiable concept. It is also true that when they're deploying vast volumes of capital, they are going to be creating positive and negative externalities. Both those things are true. The question is, how can you reconcile those two ideas? And how can you actually create a world where you are not making compromises in either of them?
There's another aspect that I think some ground you plowed while you were there is you identified 3 big structural problems with how large asset owners operate. And I guess this is true of all large asset owners, but it's easy just to go through the motions and not actually think about it this way. The first is that all the benefits of scale get captured by the intermediaries instead of going back to the members. And then the second is that there's so many layers between the member and the actual investments that nobody really knows what's happening. And then the third is information symmetry, that the asset owners themselves don't really have visibility into the markets. Can you talk me through these 3 problems and how did you work to address them at First State Super?
First State Super, when I started, was actually only 20 odd billion. It was growing very strongly. So by the time I left, we were more than 50. And today, I believe they're well over 200 billion. But when I was there, we were evolving from a much smaller asset owner to become a large one. And that's all that thinking that you referred to was in relation to that. As we sat down to think about how we needed to evolve our capability in the context of becoming a larger asset owner, rather than just make changes, we tried to think hard about what are the constraints that we were really facing into. And the first one of those was a very interesting one. And this might be relevant for pension funds that are growing strongly, like in the UK, that are smaller than the Australian ones. It has been dealt with in many respects by the larger Australian ones since that work was done. But that idea, the first one about the scale benefits, was that pension funds charge a fee that goes up with the size of the assets. But while they're not huge, they're often using external fund managers who are also charging fees that rise with assets under management. And so therefore, the pension fund and the members are not getting the operating leverage. They've got a rising revenue base and a rising cost base. They're not getting operating leverage. The operating leverage sits at levels down the chain. If you think about a fund manager, its fees go up with assets under management, but many of its costs are fixed. And not all, of course, because there's bonuses and revenue shares and things like that, but many are fixed. That's why you get such strong operating profits in the good eras of funds management. That's just not a good business model for an asset owner. The second one was about agency risk, and this continues to be the case. So between a member, a nurse or a policeman or policewoman who puts their retirement savings in a pension fund, there's a board of trustees, then there's an internal investment team, then there might be an asset consultant, and then there might be an external fund manager, and then there might be a broker. Then there might be the board of a company that the fund manager is buying. Then there's the management of the company. And each one of those represents another level of agency risk. And so there's 8 or 9 layers of agency risk that exists between the member, whose money it is, and the widget factory that's getting built. And that leads to distortions. And of course, it leads to short-termism, because at every point along that chain, or at many of those points, you drive more short-termist decision-making. And then the third point there was about asymmetry of information. And that's because certainly when I started at Aware, or First State, we primarily invested through external managers. And that's great. They're experts, but you are a long way away from the market. You're a long way away from understanding liquidity, understanding transaction costs, understanding management of businesses, a whole host of things. And that actually comes at a cost as well. That sort of thinking drove us towards our journey to increasingly bring investment management in-house, internalization. To this day, Aware manages a lot of its assets internally, and the large asset owners in Australia have been increasingly doing that over the past decade or so. It's the right thing to do, not because you just want to be a fund manager, but actually for those three reasons, because it changes your operating leverage, which goes back to members. It slightly reduces the agency risk, or it gives you more control over the agency risk, and it gives you much greater insight into what's really happening on the ground. So to that extent, and I'm not sure in the US, I think there's not a lot of internal investment management within the pension funds. My understanding is most of it's outsourced, but certainly the Canadians and Australia and in Asia, a lot of it is done internally.
And then in 2017, you made a move that raised a few eyebrows, and you left your role as CIO of, I guess at that time, it must have grown to about $75 billion. And you joined Leapfrog Investments as a partner. And listeners of the show know Leapfrog's a global impact investment firm focused on emerging consumers in Africa and Asia. And I know those guys, or some of them, and Stuart Langdon's been on the show and been in touch with Andy. I think they're really great guys, but that's a very different world from managing one of Australia's largest superannuation funds. So what were you doing when you went to Leapfrog, and what was going on in your mind, and what were you searching for?
It all came back to my inability to find investment opportunities that fitted with the governance structure that I had as an asset owner, the investment portfolio that I had as an asset owner that was deliberately creating positive social and environmental outcomes as well. Whether it was the lack of scale of so many investment opportunities that were called impact back then, the lack of institutional quality that were called impact back then, or subscale returns. There just weren't the investable opportunities for a fund like mine. Keep in mind that the big funds, back then we wouldn't make an investment of less than $200 million. Now it would be much bigger than that. And most of what's called impact, certainly back then, was just too small and not of the right quality. So what I wanted to do was create like a Trojan horse, was the idea. Could I build something that fitted within the investment parameters of a institutional asset owner that would allow them to see that you can do good, make good money at the same time? And Leapfrog is a private equity firm. I actually joined alongside to develop a listed equity strategy in emerging markets that would seek to build a portfolio of companies, of listed companies, whose businesses or products and services were creating a positive social environmental outcome. And the logic there was most pension funds, certainly in Australia, I'm sure many parts of the world, have got allocations to emerging market listed equities. It's about 10 to 15% of the MSCI All Country Index. So it's an established asset class. It's not a new bucket that anybody has to get their head around. There are a lot of reasons to believe that businesses that serve low-income consumers in those economies have got an enormous tailwind behind them in terms of growth. And so if you could leverage the Leapfrog platform, build a listed capability in emerging markets, maybe you could slip into a number of pension funds, not explicitly as an impact fund, but as a Trojan horse, so that when the reports come through year after year and the heads of investment teams realize what positive outcomes have been drawn from that portfolio, they might start thinking differently about their role as larger allocators of capital. So that was the logic. Unfortunately, we weren't able to get there. So it was one of those ones where I learned a few startup lessons. You've got to have one.
Did you never launch the fund?
No, we never launched it in the end. The challenge back then was people wanted to believe that you could deliver fantastic returns and meaningful impact. And that hope carried parts of the industry further than it should have. And part of what we're going through at the moment in the broader ESG sense, as well as in impact, is a bit of a reckoning. And it's an essential point to actually stop and reflect on what is possible and what is not possible. What I said before is still absolutely true, that everybody needs returns and externalities are real. Those are absolutely true. But how we bring that together in ways that actually meets everybody's proper objectives without hope and without hyperbole is the challenge that we have to look into now and deal with. We gave it a shot, but ultimately we weren't able to do it.
Quite different. They're private equity. They're in markets where the infrastructure barely exists. And here you come in and you want to do something with listed equities. What did you learn about building investable businesses in those kind of environments?
It is very difficult to have unlisted and listed capabilities at the same time. The governance model is very different. The fundraising cycle is very different. The legal structures are very different. I think ultimately Leapfrog and I both wanted this to happen, but I think it wasn't the right home. I think that it was still growing at the time. It was not yet mature, and the capabilities were far more attuned to private markets than they were to a listed fund. So we all learned a lot, I think. What I then did was I became the chief executive of a funds management firm in Australia called BT Investment Management, one of Australia's oldest and best regarded. And part of the reason they reached out to me, and I did say to them at the time, I love the organization and I'd love to come there, but I hadn't given up on this mission to how do we create investment strategies that work for institutional investors, but also can deliver meaningful impact as well. And so they were completely on board with that. The global CEO was a great man called Emilio Gonzalez, who shared a similar vision. And I joined there as the chief executive in Australia, but also looked to continue that work I started at Leapfrog to build strategies that fitted within the buckets that already exist.
When you arrived there, was Pendal flat on their feet with an impact approach, or did they already have something going and they wanted you to scale it?
So it was BT Investment Management when I joined, and we changed our name to Pendal, which was a very old name that we had. Now, BT Investment Management had actually been running ethical funds, possibly the first in Australia, actually, right back to the 1980s, which is now called a Sustainable Balanced Fund. So a multi-asset fund with an ethical lens to it. So they'd been doing that for a long time. And at the same time, they had built with a number of Australian pension funds, an organisation called Regnan that they own jointly with these asset owners. And Regnan was a specialist organisation that did ESG research on Australian listed companies, as well as engagement with corporates. BT Pendal already had quite a track record of evolution in this space, actually had been one of the forerunners, but impact was the next piece of the puzzle. And so together with Emilio, we decided on our strategy, which was to buy out the other shareholders in Regnan, bring Regnan internally into the Pendal group, and use it as a symbol and a flag that we were very serious about managing money in ways that was mindful of the externalities that were being created. So I certainly didn't start it there, but what we were trying to do was grow it. From that point on, we launched a whole suite of strategies, both within Regnan and actually in the broader Pendal business that headed in this direction.
What did Regnan do that was genuinely differentiated when at the time you looked at the landscape of ESG and impact funds? What were they doing?
So this was in about 2019, and it was getting close to peak sustainability. Your listeners might remember that every fund manager in the world was launching ESG funds and sustainability funds, and we were really hitting peak growth. And it was very important for us that we wanted to do it properly. and we wanted the market to know that we were serious about it. We weren't just another fund manager launching a product because it was gaining market share or flows. And so the idea was Regnan had been around since the 1990s. It had its heritage in Monash University in Melbourne. It had been at the forefront of this thinking before the letters ESG existed or the word impact or sustainability did. And so we brought it in, and we wanted to have the team and the DNA form the basis of strategies that we wanted to then launch. We wanted to bring in investors into that capability set. So we wanted to bring the sort of the genuine ESG approach from Regnan together with hardened investors, which was sort of the BT heritage. And that was the idea behind Regnan. And at the same time, the Regnan team was still supporting other parts of the group with their insights and their expertise. We launched 2 products within Regnan. We lifted a team in the UK to run a global equity impact strategy. And we also ran what you'd call these days a labelled bond fund in Australia, so green and social bonds in Australia, a credit fund. And at the time too, there weren't enough green and social bonds in the market. So we supplemented it with a sustainably screened credit portfolio, but we were really there trying to grow that market so that we could invest more in it.
You said that at Regnan, the impact case is the investment case. What did that mean, and how did that change the way you invest?
That really refers primarily to the global equity strategy that we launched. And the logic was that if you have businesses whose products and services are helping the world move towards achieving the sustainable development goals, there are a lot of obvious tailwinds, that word I used before, that you would expect behind those businesses over time. So things like government regulation, policy, consumer behavior, institutional investor behavior, all these sorts of things are likely to be tailwinds over either demand for the products or services or, in fact, for the cost of capital of the companies themselves. For that reason, I think there is a strong argument over time that if you can find these businesses that are actually doing positive things in the world, there are reasons to believe that they should get strong earnings growth and ultimately drive strong shareholder returns. A good example for that is things like when the UK left Europe with Brexit, the British government had to replace the farm subsidies that British farmers received under the EU. And under the EU, you got your farm subsidies based on size of your land. It was quite a regressive idea. Whereas in the UK, they took the opportunity to actually link the subsidies that they were going to provide to increasing use of sustainable practices on your farm. So a good little example of a policy decision that much of the world is moving towards, that's ultimately going to be a tailwind for the sorts of businesses that we were buying. Now, and so that's the argument for the impact case being the investment case. Now, I do want to acknowledge that there are many people in the impact community that would argue that a listed equity fund can never be an impact fund because it doesn't have the sort of additionality that you would get in private capital, which is perfectly true. Some people would argue that there are IPOs, there are capital raisings. People would also argue that you have a role to play as an active shareholder. Other people would argue that by increasing demand for those companies, you're lowering the cost of capital and therefore supporting the ability of that company to grow profitably. Not a debate I ever wanted to ever enter into, largely because of my Trojan horse thesis, which is if there's a strategy that can be widely adopted by mainstream institutional capital because it delivers great returns and it fits neatly into the way they build portfolios. And if that means that there are investment managers and CIOs who are at least mindful of the implications or the externalities that these organizations are creating, then I think we've actually moved the ball forward quite a long way.
Because it'll be easy to scale.
That's easy to scale, but once that mindset changes, over the last 10 years, I've watched these large asset owners say that their only job is to deliver returns. And I say, yes, I understand that, but you can't ignore the fact that you are creating these externalities, whether you like to or not. They're real. And surely there's got to be some element of accountability and responsibility when you hit this sort of size where those externalities are material. And that to me is the tipping point that we need our system to get through. It's not about compromising your fiduciary duty. It's purely just about acknowledging the reality that everything has second and third order effects. And when you are a large investor, those are very real. And surely that comes with some sense of responsibility.
I also feel like, for example, this ESG blowback that's currently going on in America, I guess I don't get as worked up over it because I feel like if that's happening, that's because at some level we haven't communicated well. I mean, if this is all true and there are these externalities, then there has to be a financial cost or risk to all that. And it hasn't either been quantified or captured or communicated in a way that's meaningful to investors, because I always say you never have to go out and make a big slide deck to argue that a higher financial return is better than a lower. You don't have to make that case. And so if these are also financial considerations, then they should be able to make it. Now, I know it gets a bit more complicated because our accounting systems don't accurately capture all that. But at the same time, especially in America, a lot of this has been oversold.
You're right about the communication, but I think we did go too far as well. I think what you said is perfectly true. These things are real and there are costs. And in many cases, those costs are ultimately going to be internalized at some point, whether it's regulation or consumer preference or whatever it might be. I do fear that we went too far with box ticking, and I think we overstepped the mark just a little bit and we lost the underlying principle. I'm not unoptimistic about this blowback because I think maybe there were elements of it that had to happen, but that whole thesis about investing in a way that's mindful of these realities, I think there are a lot of people that still do that, and I think that's good investing.
I agree with you wholeheartedly. And anytime you have something new, a new trend, the clown cars are going to pull up and the charlatans are going to be overselling, and there always has to be an adjustment, no different than AI right now. I want to go back to Regnan a bit because I think that was quite interesting aspect of your time there. And they developed proprietary impact taxonomy. I think in total you had 8 themes, things like health and well-being and energy transition, circular economy, future mobility. How did you or the team land on those categories? And more importantly, what was their approach to actually measuring whether a company was creating real impact or just telling a good story?
This was all the team. And effectively what they did was they started with the SDGs. And there was 179 individual targets underneath the SDGs. Many of them are not investable, and many of them are certainly not investable with companies in listed markets. But what they were looking for was they were looking through those SDGs to identify where there were products and services that existed or could exist that could help move the world towards achieving those. So clearly some of the ones around government were not part of the equation, but many of them you could, and in fact it was encapsulated in those 8 themes, were ideas where there were products and services that businesses could deliver that would move the world towards achieving those targets. That's how they were developed. And then from those, a universe of stocks and companies was developed of businesses that were doing things that could achieve those outcomes. And then, of course, they looked for where they could find value and growth and good investable opportunities. The way we tackled the measurement piece was to identify individual metrics for each company we invested in. They wouldn't be considered systemic impact. They would be more outputs rather than impact. So we would have a theory of change for each company that would articulate how it is that the business that they're operating in, if it grew, what would be the positive change it would deliver on the world. And then we would measure for each business the certain outputs that they were delivering. So that's how we did it. It's not perfect. It's very difficult. In listed equities, you don't have nearly as much information as you do in a private asset. And I think everybody has always struggled with how the outputs translate into impact. And so where I think most of the community has landed on is that you need to have a coherent theory of change and then measure what you can.
Coming closer to current state of play in 2022, Pendle agreed to a $2.5 billion acquisition by Perpetual, creating a large entity, about $200 billion in assets under management. That's a significant merger, and you came full circle in a way, spending years at Perpetual earlier and then helping bring Pendle back into Perpetual. Now, when you're doing a merger in asset management, culture and autonomy are everything. How did that go? And what did you have to protect? What can't you compromise on?
Perpetual's vision was to leverage the combined scale, but evolve into becoming a house of boutiques, which was designed to protect the autonomy of the investment teams. And so we had a lot of that embedded in the agreements before we entered into that transaction. We did the right thing by our shareholders in going through with that transaction, and the investment team autonomy was absolutely critical to maintain, and it wouldn't have been in Perpetual's interest not to do that. They were very clear about it and very strong about it, and so it was protected in a whole series of contractual obligations. They delivered on that. The teams are very separate, actually, to this day. There were some examples where that's not the case, but by and large, the teams were kept quite separate and they moved forward. So I just did 6 months of handover and then I sailed off.
After the merger, you moved into a portfolio of board and advisory roles, and you're currently the chair of Impact Investing Australia, as well as a non-executive director at Australian Ethical. I'd like to talk a bit about Impact Investing Australia, which is the Australian representative of the global steering group for impact investment. Can you just give kind of a high-level overview for people who aren't familiar with IIA? What is Impact Investing Australia's mission, and what are the strategic priorities that it's focused on, and so forth?
So many of your listeners would know about the Global Steering Group, which was set up originally by Ronnie Cohen. David Cameron was the Prime Minister at the time. Cameron was the person that actually put it on the agenda for, whether it was the G7, I'm not sure at the time, put impact investing on that agenda. And Australia was invited to that, even though we're not part of the G7. And what the Global Steering Group did was send disciples, impact disciples around the world to create local boards to proselytize the faith. And a wonderful woman called Rosemary Addis represented Australia in that meeting. And she came back here to establish Impact Investing Australia, which is the local board which is charged with getting the impact ecosystem growing in Australia. I've been on the board since it was established probably 15 years ago now, or close, and I've been chair for the last 3 or so. There's a number of things we're focused on. So we're a not-for-profit, and we've fortunately been supported by a number of players in the Australian market. But our focus has primarily been on trying to understand where the gaps in the system are and looking to see how we can leverage partners to close them. We've spent many years working with the federal government to try and get different sources of capital from the government in ways that can either seed early stage funds or play more catalytic roles in first loss pieces or other sorts of things that could help actually deliver institutional quality returns for impact funds. We've been working with the institutional pension funds to help their understanding with impact. We do a lot with social enterprises. We represent the federal government in a grant program that helps get social enterprises more financial ready to be able to take different types of capital. We do benchmarking reports. We're just about to release our latest market sizing benchmarking report. So there's a whole host of things. But our primary interest at the moment is in the idea of blended finance, recognizing that different sources of capital have different objectives. And actually, there may be ways to combine them and so unlock more traditional private sector capital than we would otherwise be able to do. And the Department of Foreign Affairs and Trade, the Federal Foreign Affairs Department, is doing some wonderful work using government capital in blended finance structures to catalyze investment into Southeast Asia. And we're trying to look for more of that from the government to unlock more of the impact market domestically as well.
Where was Australia's impact market 10 years ago when you were at First State Super, and how do you see it today?
10 years ago, when I was looking to invest, there wasn't much I could invest in. It's been an enormous change over 10 years. Still a long way to go, but let's just look at what's happened over the past 10 years. So there are a number of fund managers now with several $100 million doing private market impact. There's the strategies that we launched at Pendle. There are other listed market strategies that have been built. So there's a whole range of funds management delivered impact investment strategies across most asset classes. I would say when you aggregate it, there's several $1 billion of roughing. That's now getting towards more of a healthy ecosystem. The big growth here, as in other parts of the world, have been in labelled bonds. So the Australian green, social, sustainable bond market has grown enormously over the last decade. And so these are use of proceeds bonds. And again, there are many people that question whether they are impact or not. And again, that's not something that bothers me very much, because I think that mainstream investors who own these assets are getting reports that are highlighting the externalities that are being created from that capital. And if that does nothing more than increase mindfulness of the ecosystem in which we operate, I still think that's a positive outcome. I should also mention a number of pension funds have got explicit allocations towards impact. Thinking of Rest and Hester, another of other major pension funds have got heads of impact. And there's been a very subtle shift in the thinking, I think, of the senior leadership across the pension fund community. And I think it's a function of size. They're so big now in the context. So the super system in Australia always dwarfed the economy. But now for the first time, we have $300 billion funds. And we're not a big country. At that size, I think it is impossible to ignore the responsibility you bear as a large allocator of capital. And so I have definitely seen a meaningful shift in the attitude of the people that control the money. And so I think we are in a much stronger position than we were before. But we still, and if you think about it globally, I think the last GIN report, I think it quantified the impact market at about $1 trillion. And now a lot of that is green and social bonds. Is it $1 trillion or not? That's fine. But let's say it's $1 trillion. That is still, 0.4% of global capital. It's nowhere. And so my little job of how do we unlock that big capital, we're still not there yet.
You talk about something you call the third axis of finance. First axis, of course, was always financial returns. And then with modern portfolio theory, we got a second axis, which was risk. You've been arguing that there needs to be a third axis, which is impact, which somehow considers all the second order effects of how capital gets deployed. Why do you believe this is inevitable, and why will ignoring impact eventually become unacceptable?
I'd say I hope it's inevitable, and I hope it will become unacceptable. There are many people that talk about the three axes. I'm only one of them, but the way I articulate it is to say that in the beginning, there was only returns. You'd go in 30s or 40s, you'd go and see a stockbroker, you would buy stocks, you would only talk about the returns. But risk was always there. The volatility was always there. The risk of losing your money was always there. But we didn't have a way to measure it. And it wasn't until modern portfolio theory and volatility and standard deviation, as crude as that is to measure risk, it's still a tool that can be used to measure it. And once it became measurable, it became embedded in the way to think about all investment. The reason why I say it like that is that those second order effects of the investment decision have always been there. This is not a new thing. It's not like they've suddenly appeared. It's just that we didn't have to think about them and we didn't measure them. We could put blinkers on. And more, they are being measured. So emissions are being measured, and obviously accounting standards are changing. Sustainability reporting is changing. And we're becoming a bit more sophisticated where we can think that these things are real and there are real costs to them and they should be measured. And once they start getting measured, then they start getting managed and they start getting embedded into the process. The other thing, of course, that happens when things start with acknowledged and then go to measured, but I'll even take acknowledged, is that stakeholders become mindful of them as well. So say three big stakeholders: governments, consumers, and investors. Governments wear the cost of externalities. They wear them in their future deficits and their P&Ls and expenses. Consumers, once they know something about a business or a product, you can't unknow it. If you know that this product is causing serious harm, you may choose to ignore it. You may be subject to your own financial constraints, which override it, but you can never unknow it. And over time, those two things, government and consumers and investors as well, you would expect that to start pricing itself into securities and those externalities becoming increasingly internalized. Now, I would have said this with great vigor a few years ago, and feels like maybe we've taken a step back. But nevertheless, the accounting standards globally are changing. Reporting is getting more vigorous and the obligations are growing. And as I said before, I'm not sure that this step back actually isn't a positive thing, because if it means that we end up focusing on the material things rather than just ticking boxes or having political views, then that's a good outcome.
If impact becomes a standard measure that everyone eventually is going to track, what are the actual metrics? What's going to be, or maybe is, in your opinion, the impact equivalent of a Sharpe ratio or a beta?
You might be aware, I think it started at Harvard. I think it's out in a separate thing now about impact-weighted accounts, which is an attempt to quantify the externalities and embed them into the P&Ls of companies. To be honest, I think it's very difficult to do, and I don't have a good answer for that.
Are you referring to this project that Sir Ronald Cohen's been involved with, the IFVI? He was on the show some months back, and he said gap wasn't always there.
I hope so. I support it as much as I can. I'm just happy with mindfulness at this point. If by the time there's an acknowledgement, a recognition, and a sense of responsibility, I'll take that.
I want to mention this ESG continuum framework. You draw a clear line between ethical investing, ESG investing, and impact investing. I guess ethical investing is about values and exclusions. ESG is about risk management. Impact is about deliberately creating positive change. Can you give me a concrete example, or take one sector, one company, and show me what that looks like in each of those lenses?
We started with this concept of ethical investing, which was just about moral positions and wanting to exclude certain things because of them. ESG has evolved a little bit. I'm not saying it's been on a bit of a circle, but really at its core, it's just about considering the implications of those externalities on the earnings and risk of the underlying company and pricing them in. And then impact is about explicitly investing to target a positive outcome. Many church groups in particular, and Australian Ethical, where I'm on the board, started in the 1980s with Australian Ethical started with an ethical charter, which were 26 statements about behaviors and types of companies that were aligned ethically or not aligned. When you read them today, they just look like quite a prudent investing framework, to be honest. But they were ultimately about what not to own. And ESG, in the way I've defined it, which I think is the correct way, there's no reason why you can't, in the dirtiest, most evil company in the history of the world, as long as the share price properly reflects those externalities, you've factored that into your analysis. And so in theory, everyone should be doing ESG, because it's just about doing analysis on non-financial things and then considering that in your investment process. I think where the ESG movement struggled was that it defined itself as that, but then it went further and started to tilt into more sort of moral values-based positioning. And that's where sustainable or sustainability or thematic strategies came in, which are more explicit about that, targeting green energy or whatever it might be. But that all became a very blurry space, and I think to its detriment. And then impact, though, is very clear. It's supposed to be driving a positive outcome. You want to be able to at least try and measure that. And it should be in a net way as well, the positive net, whatever negative externalities are being created. In that world, it's impossible to own the dirtiest, most evil company of all time, because it's highly unlikely it would fit in that world.
You're on the board of Australian Ethical, and I guess they manage somewhere around 14 billion, and it's values-based investing, and they've been doing a while, I guess since the 80s, makes them one of the pioneers. What are they doing different from what most ESG funds are doing, and do you give up anything by putting values first?
When the business started, they established this ethical charter, 13 things that we don't want to own and 13 things that we would like to own. It's embedded in the constitution of the company, which is a listed company. They've been managing money in a way that's aligned with that charter ever since. And I have to say, when you read it, I'd encourage anyone to Google this charter and have a look. If you read it without any sort of moral or even values-based perspective and just read it as an investing framework, it's incredibly intuitive and incredibly attractive. It's basically, don't buy businesses that treat their employees badly or that gratuitously extractive. I can't do them word for word, but that framework about buying businesses that are actually behave well and are in sustainable industries in the sense that the earnings are sustainable over time has served them incredibly well. Their longest running strategy is their Australian shares fund, which has been going for 30 years last year. And that's delivered an excess return above the index of around 3% before fees per annum over 30 years with that ethical framework, which is quite extraordinary. But when you think about it, maybe it's not that extraordinary.
You've also been involved in governance work with the Northern Territory Aboriginal Investment Corporation. What's that work about, and how does that connect to everything else you're doing?
Yes, so I'm on the investment committee for, it's now called Aboriginal Investment Northern Territory. For those who don't know, we have 7 states and territories in Australia. Northern Territory is one of them, in the middle where Uluru, the big rock, is. Big Aboriginal and Torres Strait Islander population. For many years, the community there were owed mineral rights from various mining activities that were happening across the territory. And those mineral rights were going to the federal government into a thing called the Aboriginal Benefits Account. And then they would come back in the form of occasional grants. The community fought for many years to have more ownership and agency over the money that was rightfully theirs. And so a number of years ago, the federal government established this authority to steward the monies from the Aboriginal Benefits Account, or a large part of them. And so the board of Northern Territory, of Aboriginal Investment Northern Territory, is made up of the 4 land councils that represent the Aboriginal communities of that area. And then by legislation, there's a few other people like myself that sit on various committees to support the community in making the decisions that are theirs to make around the management of those monies. And the way the monies are managed, it's still being built out. And this is all relatively recent. A significant portion is being managed in the form of a long-term endowment, which hopefully builds and generates income and assets for the community in many generations. From an investment point of view, another component is built around place-based investing in the Northern Territory, supporting Aboriginal businesses and livelihood. We've been developing the governance model around that, and we are now at the point where we are getting closer to actually kicking off the place-based investment. And the whole idea is, how can the Aboriginal community themselves leverage financial capital to build their well-being over many generations. And I'm very hopeful that they'll be able to do so.
You frequently quote Michel de Montaigne, "Que sais-je," which in English is "what do I know," which I guess is a question about intellectual humility. But in finance, of course, people are rewarded for certainty and for confidence and for having the answer. So how do you hold both of those things? How do you make multi-billion-dollar decisions while maintaining that fundamental humility about what you actually know?
It helps you as an investor, actually, to acknowledge that you don't know. When you're making investment decisions, all you're trying to do is reduce that risk as much as possible by doing proper research. The way I think about it is a jigsaw puzzle. You've got to get as many pieces to the jigsaw puzzle as you can, but you can never finish the jigsaw puzzle before you make an investment decision, because at that point, there's no returns left. You are always making the investment decision in the face of uncertainty. Yes, I do love that saying, what do I know? And I do use it very often, mainly because I've seen over my career so much conviction that was misplaced. And I think that is dangerous. And I think the best investors are the humble ones that know they don't know, that know they're investing in uncertainty, that manage risk properly because of that, position sizing, exit straight, whatever it might be. And it's always served me very well. We joke about some people have a conviction to skill ratio that's the wrong way around.
You've talked about managing other people's money as a privilege and a responsibility, not just a job, not just a transaction, but a privilege. What does that belief change about how you operate?
Early on in my career, I had people really ramming to my mind the idea of other people's money, OPM, and the sort of responsibility that comes with that. The beauty of managing a pension fund like Aware was that the members were, in many cases, essential service workers. They were nurses, they were teachers, they were police officers, and this was either the biggest or the second biggest asset that they had, and certainly was going to determine for them their well-being in retirement. And when you put a face to it, it helps you take some responsibility. And it is a privilege because they do pretty extraordinary things for us. While I was at Aware, my mother was dying and spent a long time in hospital, and you see the nurses there, and many of us have had these experiences about what they do. And you really have to check yourself about what an extraordinary service they're giving to the community. And here we are, turning over billions of dollars. $7 trillion turns over in financial markets every single day. 7 trillion. That's probably an old statistic. It's probably much more than that. And I don't think we're creating that amount of value every single day. I don't know about you, Scott, but I don't think we are. So I don't think there's any doubt that as a system, we probably take more out than we give. But at the same time, the financialization of the world over the last 30 years has meant that these vast volumes of capital in the hands of a handful of fiduciaries, the way it's deployed will shape healthcare, it will shape technology, it will shape the environment, it will shape transport and communications, it will. We're fortunate, I suppose, to be in those positions, but be careful what you wish for.
On a similar note, you've also said that the investment industry needs to become a true profession, one that's ethical, sustainable, trusted, and value-focused. When you look at where the Australian financial industry is today, how close are you to that? Are you halfway there, quarter way?
I think we're pretty good, to be honest. And maybe I'm too close, but we always do very badly in the Edelman Trust Survey globally. I think financial services generally does. So I think the value that our system has taken out is greater than the value it's created. However, having said that, I do believe most people are ethical. And we're going through a situation in Australia at the moment where there's been some fraud and mismanagement with a component of the superannuation system. And unfortunately, people have lost money. I think they're being made good now, and the regulator is all over it. It's quite big in the press here at the moment, the financial press. And that's because the superannuation, it comes out of everyone's wages. So it's a federally mandated scheme. The care that is required is politically important. I was reflecting, it's been a long time since the last one of these things in Australia. There've been a few, as there are all around the world, but actually it's been a number of years. So by and large, the multi-trillion-dollar system, I think, is actually being managed quite well. I think we could do a better job communicating. And I do worry a bit about financial literacy and how we can support that. But I do think most people are pretty ethical.
Looking ahead, what is the single most critical policy or regulatory change needed in Australia or globally for that matter to ensure that impact investing moves beyond a niche category and reaches truly substantial scale, let's say in the next 5 or 10 years?
You have a minute, Scott? You ready? And one of the things I haven't talked to you about is my thesis around the 4 ways that you can solve for the fundamental impact problem. It'll go directly to your question. Imagine 2 companies that make widgets, A and B, and A is making widgets in a way that it's deliberately creating a positive social or environmental outcome. But B doesn't care. B is just making widgets as cheaply and as efficiently as it can. As an investor, B represents the market rate of return. If my mandate as an investor is not to compromise on returns at all, but to deliver the best possible risk-adjusted returns that I can, then I have to get the best possible return for the same amount of risk. Now, company A has got all this extra complexity in trying to target, achieve, and measure these externalities. And so theoretically and kind of by definition, there's no way company A can deliver the same return that company B is, unless one or more of 4 things is true. You with me so far?
Yeah, with you.
First thing that could happen for company A is there could be a government subsidy or some sort of policy framework established by the government that enables company A to deliver the same return as company B. So in the example I gave at the start of this podcast, the National Rental Affordability Scheme was actually a tax credit that subsidized the return. So even though the additional cost and complexity of delivering the impact over here, there was some form of subsidy that got the return equivalent to company B, in which case an institutional investor can happily buy company A. In fact, they would, because as we've already talked about, they're increasingly mindful of the fact that externalities are real. The second way is what's commonly called a greenium. So a consumer wants to buy this widget for a higher price from company A than company B because they know that external thing is happening and therefore the returns are comparable. That's great. The problem with greeniums is that they are notoriously unreliable. You know, in different economic conditions, maybe consumers feel differently, but nevertheless, that's the second way. The third way is if there's some form of philanthropic subsidy. So there might be a charity or a foundation that is either providing services in kind or providing some form of concessional capital for that business, which is reducing its cost of capital and therefore facilitating the same outcome. And then the fourth thing is a bit of a cheating catch-all, so you have to allow for it, and that is, I'm calling it some form of innovation that I haven't been able to identify. So the manager of company A has just identified a unique business model that has enabled it to compete effectively with company B. But my argument is, in the absence of one of those 4 things, so here's my controversial statement. In the absence of one of those 4 things, it's impossible to be able to deliver impact at market rates of return, which is what we are all striving to achieve. And therefore, in the absence of one or more of those 4 things, unlocking serious institutional capital at scale is impossible. My argument is that many of the things that we hoped for about impact, and I hoped for about impact 10 years ago, have been shown to not deliver the holy grail of great returns and great impact. And we went in optimistic and it hasn't delivered. There's many big examples of this. There's also many small examples of this. I'll give you a very small example which makes the case quite strongly. There's a big social enterprise in Australia. It's been going for over 10 years. It was set up by the right people with the right institutional frameworks. And it's an artisan product. The intention was to run it as a not-for-profit, take the operating profit margin that would have gone to shareholders and reinvest that into social purpose, which in this case was training of marginalized people to become these artisans. and give them a future. It was effectively done, had the right people, and 10 years on, it's come close, but it's never been able to do it without continuing to seek philanthropic subsidy. And the reason is, one, it's very hard to serve two masters. It's hard enough delivering returns and running a business, let alone also delivering the right social outcomes as well. And I think that's just a reality. It is very hard serving two different objectives. And I think we all know that intuitively. The second thing is that the profit motive and capitalist thinking and attracting the right talent, how you pay people, all of these sorts of things that have helped drive successful businesses are difficult, not impossible, but proven to be very difficult in the world in which we live. Now, those are two little examples, but there are probably many more. But I think all of us can point to many examples of where that hope has not been realized. What has dominated the growth of impact investing over the last 10 years is green and social bonds, dwarfed everything else globally. Why is that? Well, because there's a government or corporate subsidization of their credit risk. So when you buy one of these bonds, the government who issues it, the World Bank who issues it, or the corporation that issues it puts its full credit worthiness behind this bond, even though the capital raise is going to do a particular thing over here. And that's effectively a subsidy. The risk of those things is not the risk you are entering into when you buy the bond. And so that is a great example of number one that I said, and that has dominated everything. Now, I'm not saying this as a bad thing. I'm saying it as an acknowledgement of where we're at, as a brutal acceptance of the reality. And I'm saying that to answer your question of what do we need to do to unlock vast volumes of capital over the next decade to make this world a better place, is we need to look deep into these four things. And we need to have systems, processes, and governance models that facilitate them more effectively. A lot of this comes down to either government policy or blended finance. And if we just think about blended finance for a moment, if I acknowledge that a pension fund has a certain return hurdle that it needs to hit and certain level of risk it needs to take, and I can get there with an investment that wouldn't be able to get there unless it had a first loss piece from a philanthropic foundation or some form of concessional return from another organization for whom that return makes sense as well. And if I can blend those two perfectly rational decisions together, then actually both sides actually get what they need, and we've unlocked more capital than we would otherwise do. But to do that is very difficult, and there's not a lot of ways to achieve that in scale. So right now, if you have a social enterprise anywhere in the world and you want to get a piece of senior debt to fund it from a traditional institution, and the only way you can do that is to get a philanthropic foundation to give you a concessional loan, you have to find both of them at the moment. You have to do two sets of capital raisings. And of course, raising money from philanthropic foundations is just as difficult, if not harder, than raising money from an institutionalist. And they've all got different objectives and different areas of interest. So my dream and my hope is that we can acknowledge the fact that there are costs and complexities and trade-offs that do come with impact, and that's okay. And then think about the different sources of capital that we have around the world and find ways to bring them together at scale. And that's what certainly we're trying to do here.
Somehow it seems like this comes down to scorekeeping, because you're essentially saying this can't work unless there's somebody who doesn't have market incentives, providing a cushion to crowd in market capital.
If you think about those people, it's about, are they seeking a different outcome? If it's grant capital, for example, they don't want a financial incentive, but they want an impact outcome, which may be a function of using that grant capital in a way to unlock a lot more traditional capital than would otherwise be done.
Maybe, but it's always subject to political winds and emotional jury-rigging. History is littered with examples of governments funding all sorts of terrible things.
That's true. And by the way, this is only until the externalities increasingly get priced formally into earnings.
It seems to me that that's really what lies at the bottom of it, is we're not exactly accounting apples with apples.
That's exactly right. That's not going to happen in the near future.
But another thing that bothers me, and it might be just my limited education in things like physics and engineering, which I have like virtually none, worked in finance most of my career, is this whole thing about electric vehicles and solar energy versus nuclear. Are we really accounting for all the mining of heavy metals, all the disposition of heavy metals, all the disposition of solar panels? Maybe we are, but I don't know. And it just doesn't seem like we're necessarily comparing the costs of car batteries and all that on the environment with the costs of fossil fuels, for example. I don't know. Maybe we are, but if we are, then I think we're back to the communication problem. It's not obvious to me.
This is why Ronnie Cohen has been really pushing that impact-weighted accounts, because if externalities are properly priced into earnings, then you don't need impact investing. It's just investing, because everything then is properly incorporating the impacts. But as we touched on before, and as you just alluded to there, it's hard, and I'm not sure. Certainly, for a while, we're not going to be able to do it.
You know, it's a term over what period of time. Let's say Sir Ronald Cohen's got this new accounting methodology that actually prices in all these long-term risks. That might work for your accounting books to put everything on apples and apples. But in terms of our lifespan, maybe we would be better off in terms of cash return or cash flow purposes, not investing according to what the accounting books say, because what you and I need is we need to get to the end of our lives. And we got some years where we're not going to be able to earning.
Unfortunately, this is where it comes back to government policy and taxes, incentives, and the role that government has in managing that risk. Because, you know, if there was a carbon tax or, for example, that was done in a way that was thoughtful around intergenerational equity.
I don't know that we'll come up with that in the next 5 minutes. But before we wrap up, I want to ask you something personal. You said that your only skills are in investment management, but that the financial markets have extraordinary power to do good or ill. If you could go back and speak to your younger self when you were first starting out in the 80s, what would you tell him about the responsibility that comes with controlling capital and the power that financial markets have to shape the world in which we retire to?
I think that the best investors are ones that have very broad perspectives, that are very curious and are always trying to see beyond the textbooks and the investment theory alone and try to understand the world around them. I would always encourage any young person, and me, if I had the chance to talk to myself again, to really push an understanding of the broader system and your role in it. I use that minoxidil thing as well. I'd probably say that.
All right, Richard, I've got a few rapid fire questions for you before we wrap up. Don't overthink these. Just give me whatever comes to your mind, or if nothing does, feel free to take a pass, because that's okay too. But if you had to name the single most important challenge in the impact investing space at this point in time, what would it be?
Well, it's just the first thing I think of, but I think a lot of people are wrestling with a name. I think most people who are trying to raise impact funds are avoiding the use of the word impact because it's become somewhat toxic, and that's a challenge. And then you find that people are dancing around returns first, impact first, depending on the audience that they're trying to raise money from. And this goes back to my can't serve two masters. I think that is very difficult.
It's funny. You find impact as having a bad name right now? Because for me, I feel like it's ESG. less so on the continent. But in the US, a lot of people I've run into seem to be scrubbing their websites of ESG and throwing sustainability and impact around to the point where I think people are confusing sustainability with ESG.
In Australia, there's definitely been a bit of impact fatigue. I like to say ESG is dead, long live impact, but that doesn't make sense in the context of how I've explained it. No, I've heard from a lot of fund managers who have explicitly told me that they're pulling the word impact out of a fundraise or they're not using it. And I think you're right that there is a bit of an overlap between the sort of sustainability thematic stuff and impact. And it's much easier to raise money with energy transition fund than an impact fund.
Interesting. Tell me, what do you know now about impact investing that you wish you knew when you first joined First State Super in 2013?
My position had, especially when I was there, was always that everything creates second and third order effects. Everything creates externalities. The system's so big, we're going to create them. We need to take ownership of that. And if it is possible to invest in ways that delivers positive outcomes alongside returns, we should be trying everything we can to find that way. I used the example of Erno Rubik, who invented the Rubik Cube. When he invented it, he didn't know if it was solvable. He just assumed it was solvable. And it took him 6 months, or I don't know, but it took him a long time to actually work out how to solve it. And I said the same thing back then, which is, I don't know if it's possible to achieve this, but I'm prepared to assume it is, and let's go and make it happen because it will be fantastic. And I think now I have, as I've said before, I'm increasingly recognizing that hope is not sufficient and that actually we need to be a bit more thoughtful about how to construct investment strategies that actually do deliver what they're supposed to deliver or what we're saying they deliver.
You don't have to name names, but describe an investment you made that you were convinced of at the time you invested. It ticked all your impact boxes, but in the end, it didn't turn out and went pear-shaped. And what were the lessons learned from that experience?
I did have one. It hasn't quite gone pear-shaped yet, but it might. It's a good lesson, actually. You're familiar with asparaginopsis?
Sure, someone listening is not, so please.
I'm sure they would be, yeah. So anyway, it's a thing in seaweed that allegedly, or does, when you feed it to cattle, it reduces their methane emissions, which, by the way, are primarily burping.
Now I've learned something.
Yeah.
Today.
Anyway, so I have some investments in that and personal ones. And again, what you want it to work. And I think it does work, but whether or not it was a good investment or not is still to be seen. And part of the challenge is, and this is where the lesson is, you said before that maybe I was cheating a bit because I'm really just saying this person, using this person's money to serve that person. But the reality is that different sources of capital have different purposes. So let me just give you one little quick example. Impact Management Project and the INCAP community believes very strongly that additionality is an important component of that which defines impact. And I understand that. I recognize that if you and I were billionaires and we had our own philanthropic foundation and we wanted to deploy money in deeply impactful ways, additionality would be absolutely core to what we would do. Because we're not just going to go and buy an off-the-shelf impact fund. We want to find something that needs our capital that wouldn't happen without our capital. That is a perfectly rational and logical thing for a person with a philanthropic foundation and a lot of wealth to do. An institutional pension fund doesn't have that same motivation. That's not why they're there. They're not there to be the last port of capital for something that wouldn't happen otherwise. And so I think our definition of impact actually should evolve depending on the source of capital. I think big asset owners can do a lot of good with their capital immense good. And we need them to be doing that. But they're unlikely to be doing that dollar that if it didn't exist. No one's sitting there focused on that at the trustee board of the pension. That's where I think we were a little bit flawed. We caught ourselves up into definitions and rules before we even had an industry. I think there are governments that are prepared to take concessional returns for certain things if it has certain implications and outcomes beneficial to them and society over a different time horizon. And I don't think that's a compromise. I think that's what they're there to do.
But are we coming back to your seaweed, the thing that's not quite pear-shaped but going?
Thanks for bringing me back. Yeah. Big capital investment, and I didn't do the work properly from an investment point of view because I wanted to believe in the outcome. It may still work, but I think it's going to be challenged. And so my point there is that it's perfectly fine if my motive was just to reduce methane. But I took my eye off the investment board.
In the long run, it's unlikely that this is going to be profitable. Therefore, it's not sustainable. And you can't have true impact if you can't have an ongoing business.
Hopefully they're developing the technology and the research. I think in this particular instance, it's more just about the structure of the actual transaction that I probably didn't do enough work on. So where I was going with that, not so much that it might not be impactful, because I'm fine with it, because it's my money. It's okay. I don't mind. That one is impact first. Absolutely. But my point is I'm using that as a very speculative corollary or whatever that word is, back to a different capital for different purposes.
That could be another podcast on another day. So give me the opposite of this now. You describe an investment that you had some level of skepticism about either at the time you invested, or maybe you ultimately passed on it. And then in the end, it actually performed much better than expected. I'm talking about an impact investment though. And what was the lesson learned from that?
There is one. It's in disability housing here in Australia. There was a terrible shortage of disability housing, and what that meant was that young people with disabilities were often forced to go into aged care facilities and other sorts of things. So there was this terrible lack of suitable accommodation. And so the government increased the payment, the disability payment for rent for people who had a disability so much that it would crowd in private sector capital to develop the homes. So that normally a residential home, you get a yield of between 2 and 3% in Australia, an income yield. Post these government rental streams, you get a yield, let's say around 10. So significantly more attractive. I was very skeptical about it because of that experience I had with the National Rental Affordability Scheme 15 years ago and government policy and various things. But that's worked out. That's worked out well. I mean, there's some poor operators that have done poorly, but quality operators have delivered good returns. They've built good houses, and we have a lot more people.
What was the lesson learned that somehow clouded your vision of the potential there?
The reason why I was concerned at the start was uncertainty over government policy. And I suppose the lesson I learned was government policy is always uncertain. There are mechanisms that you can evaluate and look into that might give you sufficient certainty over your time horizon or the particular investment that you're looking into. So I think what I didn't do with that one was look deep enough into the nature of the particular government support and how it was going to operate. It's a boring investment lesson, but true.
If someone wants to get into the impact investment space, and ostensibly I'm talking about someone who's a bit younger than you and me, where would you advise them to start, or how would you advise them to cut their teeth?
I would advise a young person who's passionate about the space to work for as long as they can stand it in traditional investment management. Firstly, try and become entrepreneurial in the sense of spreading their beliefs within that organization, but also learning the trade of investing properly and the constraints that exist over mainstream investors. Because I have found that very often I'm one of only few people that have come from mainstream investment management into this space. And I think that's a shame, because I think that's led to a lack of understanding about how decisions are made and how traditional governance models operate and how you can work to change it. And so I would encourage everybody to hold those beliefs, but actually try and work within the traditional system for long as they can stand it.
In other words, get a good foundation. You got to know the rules before you can break the rules. Huh? Richard, this has been really good. Absolutely fascinating. And I want to thank you for taking the time to go through all this with me today.
I don't know. I went off on some tangents there, Scott.
Well, that's what it's all about. I love to hear the tangents. And I've learned a lot. So before we wrap up here, tell everyone where they can learn more about Impact Investing Australia and Australian Ethical and all the different things you guys are doing, your website, social media, all that good stuff.
Impact Investing Australia, I think we have a webpage. Learn more and also support what we're trying to achieve, please. I'd very much encourage you to reach out to us through the website. Australian Ethical Superannuation. It is an extraordinary organization that I'm very proud to be part of. We manage money, we manage superannuation funds. You can check it out at australianethical.com.
And what's the best way for someone to reach out to you if they want to get in touch?
Through Impact Investing Australia is the best way, or LinkedIn.
Is the Impact Investing Australia, is that a .com site or what?
ImpactInvestingAustralia.com.
Everyone go to ImpactInvestingAustralia.com and AustralianEthical.com.au. Lots of good information there. Richard, thanks again.
Thanks, Scott.
All right. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, SRI360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.